Look, you check your bank account and see $10,000, maybe even $50,000 sitting there. You feel relieved. You tell yourself, well done. I did what everyone else does. I fulfilled my responsibility. Maybe there's even a bit of quiet pride inside. But let me tell you something honestly. That money in the bank is not as solid as it looks from the outside. While it just sits there, it's losing value every single day without you even noticing. You know inflation. It silently eats away the purchasing power of every dollar you own. You think you're building a safety net for your future, but by keeping that money idle, you're actually getting poorer day by day, even if you don't realize it. By the end of this, I'll clearly explain why an emergency fund can often become your biggest financial burden, and I'll show you step by step how the banking system turns your natural fears into its own advantage. First, let's look at a simple piece of math banks don't want you to think about. In the US, the average savings account gives less than 1% interest, while inflation eats away your money every year. Think about it. The bank gives you 0.5% annually, but inflation takes 3% or more. That means while you think you're saving, you're actually paying around 2.5% per year just to keep your money there. Meanwhile, the bank uses your money and makes even more profit. If you leave $50,000 there for 10 years, its real purchasing power drops to about $37,000. You lose $13,000 without spending a single dollar. I call this a silent robbery. Banks lend your money out at high interest while giving you almost nothing in return, and you remain completely unprotected against inflation. So why do people fall into this trap? It's not because they don't understand math. It's because our biology doesn't match today's financial world. That poverty brain, someone who grew up with financial instability, sees every expense as a threat and every dollar in the bank as survival. Seeing a big cash balance makes your primitive brain say, "We're safe now." But that false sense of security pulls you into the behavioral finance trap called loss aversion. The fear of losing money feels twice as strong as the pleasure of gaining it. So you avoid seeing red numbers in investments, choosing short-term comfort while accepting long-term loss. This is where the path to wealth begins, recognizing this trap. To truly escape this mindset, you must understand banks are not vaults holding your personal dollars safely. They operate on fractional reserve banking. They keep only a small portion of your deposit and lend out the rest. Your money becomes someone else's car loan or business loan. The bank earns 7%, even up to 25% on credit cards, while you get almost nothing. Keeping cash in a low-interest account means you're basically an unpaid worker funding the bank's profit machine while paying the inflation tax. Wealthy people understand this game. They never let their money sit idle. They know money must move to grow, and idle money is dying money. Now let's put a price on this fear using opportunity cost. Imagine you're overly cautious and keep $50,000 in savings, even though you only need $10,000 for emergencies. If you had invested the extra $40,000 in a simple index fund, returning 10%, in 30 years, it would grow to about $697,000. That means your decision to keep it in the bank for emotional comfort cost you over $650,000. You are essentially paying hundreds of thousands of dollars to feel safe. One major reason people fall into this trap is misunderstanding what a financial emergency actually is. Most people treat their savings account like a backup wallet. They see money there and think they can spend it on vacations or furniture. But boundaries matter. A roof repair in 5 years is not an emergency. It's a planned expense. An emergency fund is not for lifestyle upgrades. It's financial insurance to prevent you from selling assets at the worst time. Liquidity is like oxygen. If markets crash and you lose your job at the same time, without cash, you're forced to sell investments at the bottom, permanently destroying wealth. The solution is not to empty your bank account, but to use what I call a liquidity ladder. First level, your checking account, holding about 1 month of expenses plus a buffer. This is your sleep well money. Second level, your true emergency fund, kept in a high-yield savings account, earning 4 to 5%. If you're single and renting, 3 months of expenses is enough. If you have a family or mortgage, aim for 6 months. Once that's filled, you must force yourself to stop adding to it and direct every extra dollar to the third level, your wealth engine. This is where the magic happens. Every extra dollar goes into retirement accounts or brokerage accounts, buying assets like index funds and real estate. This gives you ownership in the global economy and lets you fight inflation properly. If you're afraid to invest a large lump sum, use dollar cost averaging. Split your cash into 6 parts and invest 1 part each month automatically. This removes emotion and turns market volatility into an advantage. If the market drops, you actually benefit by buying more at lower prices. If you're young, your biggest risk is not market drops. It's playing too safe and running out of money later in life. Historically, the stock market returns around 10% annually, while inflation is about 3%. That's a real return of 7%. Cash earns almost nothing. The difference between holding cash and holding assets is the difference between retiring comfortably and working until you die. To implement this, you must shift your identity from a saver to a capital allocator. Every dollar should be a worker. If it's sleeping in your account, you fire it and move it to your investment portfolio. Calculate your monthly expenses, multiply by 6, and that's your maximum cash limit. Anything above that should be invested immediately. Automate everything so you don't even have to think about it. Comfort is expensive. Keeping all your money in the bank is like paying a tax to your own anxiety. Real wealth requires getting comfortable with discomfort, seeing your net worth fluctuate. The safety trap promises security, but delivers hidden poverty through inflation. True financial freedom comes from assets that work harder than you. Set a cap on your cash. Invest the rest. Your future depends on what you do today. Don't choose the easy path now and trap your future self in a hard life.